The narrative on Bitcoin shifting once again. Has the pandemic legitimized crypto assets? Is Bitcoin the hedge? What is Bitcoin's role in the economic cycle? And is Bitcoin's race to 6 digits a fantasy, or is it inevitable? Welcome to Word on the Block, the series that takes a deeper dive into blockchain and the emerging technologies that shape our world at the intersection of business, politics, and economy. It's what we cover right here on Forkast.News. I'm Forkast Editor-in-Chief Angie Lau. Well, in mid-September, 17 top Fed officials agreed to allow inflation to run moderately above 2% for some period of time. While fear of inflation looms around the globe, investors are looking towards alternative investments to protect their portfolios. For some time now, this alternative investment has been gold, but in 2009, that changed. We now have what's often referred to as digital gold, or the almighty Bitcoin. And we're seeing more and more sophisticated investors flocking towards Bitcoin. On this episode of Word on the Block, we're going to answer the question, is Bitcoin the hedge? And to answer that question, our guest today is the principal of Zerocap, the digital asset firm for private clients. Trent Barnes, welcome to the show. It's great to have you on.
Thank you for having me, and glad to be a part of this.
Absolutely. Okay, so let's talk about what you've been doing in this space. You've been in this space for a little bit, but increasingly your business now serves the kind of clientele that once upon a time would have mocked this space. We're talking about family offices, high net worth, more the institutional, traditional investors, and they are increasingly coming into this space. Tell us about what their needs are right now.
Yeah, definitely. So essentially what we're finding, particularly with COVID pandemic conditions, uncertain economic conditions, particularly since March, and there has been a real increase in interest from our investor and client base. So we traditionally deal with family offices, high net worths, but one of the really interesting demographics for us is the emergent wealth, which is that wealth that isn't really covered on any private bank client list. It's the sort of the wealth that we would classify into the demographic of sort of millennials and potentially even Gen Z. Now, it's quite young, but essentially property markets globally are completely out of control. You're in Hong Kong, I'm in Melbourne, Australia. Once considered the world's most livable city, is now the world's most lockdown city. But regardless, we both live in cities that are some of the highest property prices in the world. So where do the emergent wealth turn to? And so digital assets, which is an asset for a digital age. And so that's why I guess Bitcoin being at the, representing over 50% of the total crypto market share, Bitcoin has been one that not only the emergent wealth that aren't necessarily investing in the traditional legacy assets that their parents or Gen X or baby boomers were investing in, they're going to Bitcoin, but also traditional sophisticated investors. Because what we've seen is that Bitcoin has become a validated asset, particularly because of the institutional inflows and the institutional protections available. So yeah, we definitely see from our investor and client base a lot more curiosity because it seems to be a lot more certain, more so than it was back in 2017, amidst the ICO boom. So.
Yeah, and it really feels like the momentum of emergent class and just new liquidity into the space has been accelerated since COVID.
100%. In March, we saw a black swan, a liquidity crunch, which, it affected all financial markets. And so, Bitcoin, retraced like 50%. But it's, when we talk about Bitcoin being an inflation hedge or a safe haven asset, in a liquidity crunch, all markets and all assets will just go down because there's, unprecedented uncertainty in the market. And particularly if investors are looking to make margin calls. But what we also saw out of March was the rise of the stablecoin, which is, I guess, that store of wealth where, particularly in, with low volatility, it maintains, a relative, 1-for-1 against the US dollar. There are other stable coins as well, but the US dollar is the strongest one out of them all. But particularly since March, since that event, what we noticed was a retrace. But then there was just a lot more uncertainty within the existing financial system, within the government's decision to boost quantitative easing, to go on unprecedented bonanza of money printing. I think the Fed's printed 3 times more this year than they did back in the GFC in 2008. So I really think that this has increased the curiosity for a lot of our client base. They're asking a lot more questions. They're wanting to be educated, and not necessarily on what is a private key, what is a public key, because a lot of those institutional custody protections and solutions are already there for them. They're just wanting to understand, how does this fit into a portfolio? How does this, and we only ever talk about Bitcoin as an addition to a portfolio. I mean, there are some investors that like to go, quite high. I've got friends that have 50% of their portfolio in Bitcoin. Now, that's really quite high, but a lot of our investors tend to be attributing or allocating between 1% to 5%. And that's, because it's an asymmetric risk profile, the asymmetric risk profile of it means that a very small investment can, equate to, minimal losses or, extremely high returns, particularly if you look at the track record of Bitcoin. I mean, it's still the best performing asset over the last decade, the last 5 years, even this year. So I think it's got a proven track record.
Absolutely. I mean, you just take a look at how equity markets have been performing. And, often Bitcoin, we talk about the volatility. There's no doubt there. But I think in COVID world, that volatility is just baked in. You shared a recent report from Zerocap with us on Forkast.News calling Bitcoin as a hedge. You stated that there has never been more important a time to invest in Bitcoin and Ethereum. What's your thesis here?
Well, now has always been the right time to invest in Bitcoin. And if you ask any of the early adopters, they saw that the programmatic money supply schedule, as we go into, the last Bitcoin will be mined in 2140. So it's very predictable. It's borderless, it's permissionless. And so it's one of those things, and I think Obama called it walking around with a Swiss bank account in your pocket. It's more like a Swiss bank where you are the CEO, the teller, the manager all in one. And so I think, particularly with Bitcoin now, we released this report and we tried to do it in a way that was really digestible for a lot of our investors. So we try to really minimize the real technical aspects of Bitcoin and the Bitcoin network, which, is really quite beautiful in terms of how, it came about and how it solved the double spend problem. But for our investors, they're not necessarily interested in how it all operates in the background. What is a node? What is a miner? What do I do with the private key? What they're interested in is finding, confidence. And finding opportunity and trusted partners to be able to work with. And so you'll notice that there's, the retail market will typically go to exchange. There's a over-the-counter market, which is off the market, which doesn't reflect what's happening. So the retail market only sees what's going on in exchanges. So if you look at CoinMarketCap, you'll see Bitcoin sitting around 10.6 at the moment. But if you really look at the over-the-counter and off-the-market flows, then it primarily represents 80 to 90% of all transactions happening in Bitcoin. And so if the price was actually reflected what's happening off the market, on the market, then we'd see a very different price, something more towards that, 6 figures, as you mentioned at the start. And so with Bitcoin, this is the hedge, we've noticed more curiosity. Our clients are wanting to be educated. They're wanting to find confidence. And what happens if I lose a ledger? But that's where the institutional custody protections come in. Fidelity, $1 trillion asset manager, entered the space. You've got BitGo, that's essentially, been the creme de la creme of custodial solutions. But now you've got some really interesting ones coming out, particularly multi-party computational MPC technology, which to us is an evolution of the custody solution, because it breaks down the private key into multiple different shares. So it just makes it a lot more distributed and less prone to hacking attacks, like we saw on KuCoin. I think it was like 200 plus million, a few weeks ago. And so, some of those things that kept institutional investors, private clients out of the market a few years ago, a lot of those uncertainties or things they're worried about have all been alleviated due to what's available now. So
there's a technical innovation that is addressing that, and then on the regulatory front, though, in the real world, you're still in what is a legacy monetary and capital system, and that includes tax liabilities and paying your taxes. That for preservation of wealth, obviously, there is a good thing when you pay taxes, but obviously, when it comes to crypto, there has just been a lot of vagueness, and not only in Australia, but around the world, in the US, in nations around the world. And so how does one address that? Could that be a detriment to the liquidity that is looking to get into this space?
I think, if we'd had this conversation in 2017, I'd definitely say yes, 100%. You essentially saw in 2017 the retail market get access to opportunities that were typically restricted to accredited investors, or what we call in Australia sophisticated investors and institutions. So, the regulators aren't necessarily there to regulate markets. In my opinion, they're there to regulate human behavior. So although we see in Bitcoin and the network beautifully played out are the game theory incentives that incentivize people to participate and to act in a positive and productive manner, and it incentivizes good behaviors. But we don't necessarily see that in the markets. As we saw, there are multiple different scams, fraudulent activity, and the SEC has been coming down on ICOs over the last few years. Even more recently, Salt Lending, I think, has had to pay back 47 million of their capital raise. And so the regulators, I think, I've sort of got mixed feelings on this. Like right now, I think we're at a really good point. But if we had regulators at the very start, if Satoshi Nakamoto had actually gone to the regulators and made them a part of the conversation, we wouldn't have Bitcoin now. We wouldn't have a lot of the cryptocurrencies that we have now, the privacy coins or any of that. We'd probably have something similar to what you would have, call a central bank digital currency now. So, fast forward to today. The regulators, particularly in Australia, have been really proactive, productive, working with the community. There's very clear guidelines around the treatment of cryptos, particularly for all participants in the crypto economy, be them, crypto exchange providers, people wanting to purchase crypto. The Australian Tax Office has very clear guidelines. It's considered as property, so you'll pay capital gains tax on it. The AUSTRAC, which is the AML regulator here, very clear guidelines. If you are an exchange provider, that you need to, there's your reporting obligations. Also ASIC, which is the Australian Securities Investment Commission, they're very clear, very similar to the SEC of what constitutes a security or not. So any projects looking to come out, they just need to abide by the guidelines that put in place. Now, if we go overseas, you've got a really interesting thing going on in the US, like Ripple, recently have been talking about wanting to leave the US just because of the regulatory sort of squashing of what they would consider to be, a free, open market of, ideas and projects coming to life. But in my opinion, I think regulators, globally, even though there's no real, international framework that everyone abides by, I think that they're wanting to be a part of the conversation. And just on a side note as well, originally I'm from New Zealand. New Zealand's got, I think it's one of the 5 countries in the world that doesn't have capital gains tax. So really attractive for crypto digital asset holders. But in short, I'd say that the regulators in at the right time. They've learned, and from what happened in 2017, they're meant to put those protections in place, which is then bringing on a new wave of investors like the investors that we deal with. So
that I mean, it's a huge question. And the other huge question that a lot of people are speculating about, including our recent conversation with Tim Draper, the famed Bitcoin investor early on. And when we spoke, of course, I asked him about his claim that Bitcoin will reach six figures, that $250,000 mark by 2022, or even by early 2023. Increasingly, as we see the unending printing of money, we know that Bitcoin has a finite. It is a finite supply, and so obviously that suggests that as more people demand it and as supply goes down, it's just going to drive up the price. In your view, do you think that we will get to six figures sooner or later?
The value of Bitcoin, in our mind, we don't tend to speculate too much on price because we think that the real value is in, hedging the tail risk, particularly for portfolios. As an asset, as an investable asset, I think it's certainly, proven through its track record, regardless of the short-term volatility. If you look over the long term, there's an increasing upward trend that has just been going up and up. Now, if we look at, the six-figured Bitcoin, I think the Winklevoss twins came out and said, 500,000. And that was based off of the comparison to gold's market cap. Gold has a market cap of 9 trillion. Bitcoin's market cap's roughly 200 billion, I think, or I believe. And so if you 45x that or 50x that, it gets us to a price of 500,000, which would be, super nice. Now, if you look at, the whole scarcity model of what Bitcoin represents, that's where it comes down to what is, sound money, what is, real value. Little story from when I was a kid, because it's one of those things that kids understand even. I'm not too sure about yourself, Angie, but I played with marbles when I was a kid. And
okay.
So I ended up building a pretty substantial marble empire. And but what I did do, and at the time, it was just one of those, something that's sort of inherent within the behavior of, the circles I used to walk in as a kid, was that you would always trade the ones that you had, like if you had a lot of the same type of marble, you would trade it for the ones that were more rare. And so even as a child, when I look at, obviously what we're doing today, I always reflect back to that time as a kid, as I built my empire, was I was always trading for, those ones that had, they were really beautiful, that had swirls or whatever, but it was really unique. And so coming back to, the price of Bitcoin, what could that look like today? Bitcoin has a deflationary property built into it already. So even though we know that it's going to, the last Bitcoin is going to be mined in 2140, there's 18.5 million Bitcoin in existence at the moment. What we haven't factored into account necessarily is how many Bitcoin have actually been lost over the years. Now, if you put a rough estimate, you say 2 to 3 million. So if that is the case, then we're roughly sitting at 15 million Bitcoin. Now, does that then, it obviously makes it more scarce. Does that also then increase the value of it? Well, value is always dependent on what the market's willing to play or willing to pay for it. And that's where I think, if you look at the Austrian School of Economics, they look at, what is sound money, or what is good money? It is what the free market decides money is. What we have in today's environment is obviously the case of fiat, where governments not only decide, but through taxation and through the services and goods, or goods and services, that the prices are always valued in it. So it's the market is basically saying that Bitcoin is money. It's a store of value, just like gold is money. It's a store of value, just like other asset classes that they're getting into. So if you were to ask me what I think Bitcoin is going to be at by the end of the year, it's not something we tend to speculate on, because we think the value in it's not necessarily in the price, because we've got a track record of the prices. we know that it's going to go up as long as the market and the participants in that market continue to value it as so. And we've got that validation not just from retail but also from the institutional investors. And just conscious, I've been talking a little bit, and I get quite excited on or quite enthusiastic or quite energized when talking about these things. But even if you look at the institutional investors recently this year since March, Paul Tudor Jones came out, said that it's the best inflation against exuberant cash printing.
Yeah.
You've got multiple different companies moving their cash reserves or the cash balance into Bitcoin because they think it's a much more safer hedge.
No, I totally want to pick up on that point because it is more of these traditional trusted voices getting into the space. I think price is an interesting marker for people who are on the periphery and then wonder about why more and more people are pricing one Bitcoin or one asset at such high levels. And that's actually, both of those things is actually what draws the kind of money that we haven't seen come into the market, into crypto, into this industry until really increasingly this year, as that inflationary hedge, as that hedge play, as that digital gold play. So that's what's really interesting because you actually are asked to be stewards of a lot of this type of new money that is getting into the space, which is really important, as you know, because at the end of the day, it's what somebody is willing to pay for what you are willing to sell. So if there's more money in the market, if there's more demand, obviously what you have is increasing in value. And so in your view, when you are dealing with your family offices and even all the way down to emerging wealth, this kind of language in that attracts this money in the periphery is intensifying, it feels like. Yeah,
no, definitely. And so one of the big things for us is that a lot of our investors or traditional investors that have moved into the digital asset crypto space, they're looking for yield. And so that's one of the the big plays that we see through to towards the end of this year and through next year. I mean, in terms of what's been going on in the crypto market with the futures, with some of the the recent news that has come out, we thought that was going to like the BitMEX news or the BitMEX event. We thought that was going to have some, a major effect on Bitcoin, but it didn't really seem to move much.
It didn't really move much, except out of BitMEX is what we actually saw.
Yeah,
the market
a lot of money
itself.
Moved out of BitMEX.
Yeah. I mean, you talk about yield. What about DeFi? Is that changing the game?
Yeah, DeFi is something that we have looked at. It's not exactly ripe for our investor, our client base, purely because of it feels like it's another bubble forming. It feels like 2017 all over again. What we're noticing is that it's almost like in that bubble graph, the exuberant stage, the yield farming craze that happened, the amount of time and energy, that you need to invest in it. So for us, that's why we have Ethereum as, particularly one of our assets that we speak about, that we educate on, purely because you can have all these different DeFi plays, but if you really look at it, what are they built on? Ethereum is the protocol that 9 out of 10, 10 out of 10 are actually built on. And so if you want exposure to that DeFi market, then Ethereum is an amazing investment for that. If you actually do want to invest the time and learn yield farming, then I almost feel like we're sort of on the way down. If you look at the DeFi market and how far it's retraced back, it was like a golden period between like April to like July or August, where you saw like Yearn or Yearn, go from like 1,000 up to 40,000 and then back down to like 18,000 or so.
Well, it's equivalent to almost a commodity play. I mean, that's essentially, Ethereum being the fuel for what we're seeing in DeFi.
100%. And just adding on to that, like the Ethereum investment case, particularly with what's coming with Ethereum 2.0, the staking model as well. But the ETH that's getting locked up in the DeFi space, it's almost starting to be considered as a store of value, not necessarily in line with Bitcoin store of value proposition, but still there's a lot of conversations are happening around that. We're getting asked a lot of questions. What is Ethereum? How do we invest in it? Why is this going to be a good investment for us?
Well, one final question before I let you go, and I'm sure it's on the minds of a lot of people in the market right now. Will more of this institutional, traditional family office money be coming into the market in your view?
100% in my mind. If we look at the market, the amount of conversations that we're having with family offices that are wanting to diversify their portfolio to hedge out, the inflation risk. And we haven't necessarily seen the full impact of, what inflation is going to look like. But our clients are, particularly the ones that are forward thinking. A lot of our clients have, through our conversations, have been talking about, we've been on the sidelines, we've been watching, we've been waiting for the right time to enter. And like, as you would know, if you're sitting on the sidelines waiting for the right time to enter with Bitcoin, when it goes up, you're just waiting for it to come back down. When it goes down, you lose confidence and you're uncertain. And so I think, particularly now, because of what's happening in the macro conditions, that we're starting to see, even publicly traded companies like MicroStrategy, that would have taken 6 to 12 months for them to have passed that through. So I think we're not yet seeing, really what's going to be happening in 2021, because a lot of those things are in play at the moment. But yes, 100%, I do believe that, based on the conversations we're having with our client base and based on partners within the space as well, and the conversations they're having with their high net worth clients as well. So, yeah.
Well, thank you for this conversation and sharing all of these observations in this space. There's no doubt that there is more liquidity coming to the market as the general, more traditional markets, the monetary system creates the roller coaster effect. We're all holding on really tight, but it's interesting to see that more and more interest is getting into the crypto space. Trent Barnes, thank you so much for your insights.
Thank you, Angie Lau.
Appreciate you coming on the show. And thank you everyone for joining us on this latest episode of Word on the Block. I'm Angie Lau, Editor-in-Chief. Until the next time. If you like that, come back for more. All you have to do is click like, always comment, we love that, and subscribe. And don't forget to watch the next one.